Hey, everybody, welcome to the second quarter scouting report. I'm Adam Koch, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group. We've got a lot to go over today, so I'm just going to jump right into the material. Always like to start with a quote of the day, and this one's pretty appropriate. Bob Hope said, "A bank is a place that will lend you money if you can prove you don't need it." So, in light of all the things going on in the financial sector, banking sector, the couple banks that have failed, I thought this was a pretty interesting quote, maybe even a little bit funny, if we can throw some humor at what's going on in the world today. So, with that being said, let's go ahead and move into the bulk of our content here. I always like to, not always, I shouldn't say always. I started last time during our market outlook with this image, and I think it's appropriate again this year or this quarter, because I think in retirement planning, we think of retirement projections as this linear, simple, path from now till the end of our lives. Whether that's the path, whether there's little, stops in between, like a train. The train stops every time you change jobs. The train stops when you have kids. When the kids go out to college, the train stops. It's almost like there's all these transitions in your life. But when it comes to retirement planning and then retirement income planning, when you retire and you're generating income for yourself to ensure that you never ever run out of money and never have to go back to work, I still think that we've all been taught, I guess, our whole lives. And the industry has taught us to think in terms of linear rates of return, linear withdrawal rates, everything linear. And the fact of the matter is, that's just not life. Case in point, the market, when you look at the stock market, a good portion of stocks in the stock market, when you look at the last couple years, stocks peaked, depending on what you're looking at, in February of 2021. When you look at things like technology, biotech, pharmaceuticals, internet stocks, things like that. And I don't have the chart this time. If you want to see that, go back to the market outlook presentation that I did back in January. But anyway, for the sake of this conversation, the market just hasn't done all that well this past couple of years. And I think that what we were used to for a while was a lot of being shaken up. Whether it be 2010, the market was down and came back really fast. 2011, we had the U.S. Treasury downgrade. The market went down 20% and over the course of a couple months and then came back very quickly. We had the 2015 and 16 double whipsaw, as I call it, where the market goes down over 12%, comes back a couple months later, doesn't quite hit a new all-time high, then it goes back down again, 14 point something percent into the new year, into 2016, and then it comes back again. But over the course of, call it 20 months, the market went nowhere. You've got 2018, where the market did really well right up until I think it was about September 23rd, if my memory serves me right. And then all of a sudden you had this 20% drop in about 59 days, which we thought at that time was one of the fastest drops, or one of the fastest drops on recent memory, that's for sure. But it turned out to be one of the top fastest drops in U.S. history, thinking, how could anything ever go faster than that, right? Well, then we had COVID in 2021. The market goes down 34% in 22 days. And then miraculously, while we're all stuck at home, we're all sitting in our houses, restaurants are closed, we're not allowed to leave, we got to wear masks everywhere if we do leave, and the market comes back. And 29 days later, it comes up 34%. And people are sitting there going, am I supposed to be investing right now? Or is this what we call a dead cat bounce? Is this thing just going to head back down again, and maybe worse, lower than before because of the pandemic? And then since then, we've had this choppy environment where, again, the market peaked. I shouldn't say the market, because it depends on which major market index you're looking at or index you're looking at. But many stocks peaked in February of 2021 and have been going down since, with the exception of what I would say October seems to have been, at least so far, October seems to have been a bottom in the stock market. Now, is that the ultimate bottom? Can we say for sure that the market has bottomed and that the worst is behind us and we can move forward with green lights and green pastures and ride off into the sunset? No, we definitely cannot. And that's why I show this image here below, is because I think it's so important to understand that there's going to be pitfalls. There's going to be rough rides. There's going to be times when we need to reverse progress in your retirement plan. And anytime these things happen, we just need to be as prepared as humanly possible for these things, so that it's no surprise when it happens. And then furthermore, for those of us who are retired, We need to make sure that those who are retired have enough what I call gunpowder, or in other words, they need to have a portfolio that is conducive to a retiree, not somebody who is adding money to their portfolio, but rather somebody who is taking money out of their portfolio, which generally means it's going to be a little bit more conservative, if not a lot more conservative, than a working person's retirement portfolio. All right, so I'm just rambling here. Let me jump into the details. So first, let's talk about the stock market. As I look at all the different asset classes from a 30,000-foot view, this is a really, really interesting picture for me because this has been this picture, this chart, it's called a relative comparison chart, has been kind of similar for the past, I'd say, 6 to 7 quarters. And this time it's different. It looks different than normal. So what we have here right now is it's a ranking system, basically, asset class ranking. We have money market currently at the top, but we have international ranking above U.S. stocks. We have U.S. stocks ranked number 3 here, and then we have small cap U.S. stocks ranked 4. But as you can see, international stocks and U.S. stocks have both been kind of catching up over the last, call it 6 to 8 months, and catching up to money market or cash, or the cash equivalents, and we're starting to see, a real solid bottoming process forming, because the market doesn't just bottom and then we go screaming to new all-time highs. It doesn't always work that way. Every time the market goes down isn't COVID. Let's put it that way. But you can see down here at the bottom, which is interesting, is even though the market's been doing as poorly as it has this past year and a half, 2 years, bonds, 20-year Treasury bonds, this is U.S. Treasuries, are actually second to last ranked. And then commodities are actually down in the basement at this point, which is really, really interesting. So as I look, another way to look at the market is what's called a relative rotation graph. Upper left is improving versus the market. Upper right quadrant is leading or beating the market. Bottom right is weakening versus the market. And lower left is lagging or underperforming. It's the worst place to be down here on an absolute basis anyway. But on a relative basis as compared to, in this case, the S&P 500, what we're looking at is the NASDAQ 100, so top 100 stocks of the NASDAQ and the entire NASDAQ composite currently outperforming, or in other words, in the leading quadrant. So best place to be right now. And this is, by the way, a weekly RRG, a weekly relative rotation graph. So this is not a daily relative rotation graph. I prefer weekly because I like the intermediate term time frame. I don't really invest on a short term time frame. So down here in the bottom left, we've got the Dow. So large cap stocks, have kind of been beaten up this last, call it, 8 weeks or so. We've got T-bills, so in other words, your money markets that are kind of sitting here starting to lag because the market is starting to outperform cash equivalents. And then you've got 20-year Treasuries, which were starting to make a rebound here. But as you can see, they started to improve versus the market, and then they started weakening again as interest rates have started to just chop around. What you get is as interest rates go up, bonds go down. As interest rates go down, bonds go up. And then you get this back and forth that I'll show you here on a chart in a minute when we get into the bond section. But kind of going nowhere right now. In other words, right now bonds are somewhat range bound. When we look at the S&P 500, the blue shaded area is the 200-day moving average. And what that is basically the average movement of the S&P 500, or the stock market in this case, as represented by the S&P 500, over the last 200 days. So it just smooths things out, smooths out the trend. Now, why is it so important? I like to use the analogy that whenever we're below the 200 moving average, we're underwater. And we can stay underwater for a certain amount of time. See this little dip right here in March? Well, we can stay underwater for, a few days, even a few weeks. We don't want to stay underwater for a long time. If we do, that's not good. When we see lower highs and lower lows, so this is a high here, here's a lower high. Here's a low, here's a lower low. Here's a lower low, a lower high, a lower low. You could argue that this is a higher high when compared to this high right here. So you can draw, your eyes back and forth, and you could say that this is maybe a higher low. So it was almost like last summer, the market was trying to rebound. It was trying to find a trend reversal, but it just didn't do it. And you can see here, 1, 2, 3, 4 days, nice big march northward, and then all of a sudden just a big gap down, a big terrible day, a couple kind of indecisive days, and then the market just kind of fell through the floor at that point. So a failed reversal pattern, if you will. But then we have this low here, a high, higher low, a higher high, another higher low, and now the market's trying to break north or break above these February highs right here, all while in the context of being above the 200-day moving average, or in other words, above the 200-day trend line, which also means we're above water in my book. So why is the 200-day moving average important? Let's add some context here. The reason why the 200-day moving average is so important is because not much good happens below the 200-day moving average. This is 2007 to 2008. You can see we went below water a little bit here. Again, a few days, few weeks, no big deal. We can always rebound and head back above it. But once we get below it and stay below it, we need an oxygen tank at a certain point. And you can see here it tried to bump up above, or just below, I should say, the 200-day moving average in 2008. Then it headed lower, and we just didn't see any higher highs or higher lows, right? This is just a total ugly downtrend, but the 200-day moving average tells us, look, if we've got the markets below its 200-day moving average and it's sloping down and we're seeing lower lows and lower highs, that's a pretty obvious indicator that we're in a downtrend, and that we probably need to take some sort of conservative measures. So this is 2007, 2009, but look at 2000 and 2002. So same story. Got the dot-com bubble pops back here, 2000, 2001. We got lower highs, lower lows. Here you could argue the market tried to go through a trend reversal. We got 1, 2, 3 equal highs here, relatively equal highs. Excuse me. And then the market just kind of heads down. That's a trend breakdown right here. So below this low here, it tries to bounce but can't, and it heads lower again. Then we get 1, 2, 3 lows, not exact, but relatively similar lows, and then the market starts to find its way higher. Not only higher highs right over here in July, call it, of 2003, but it's above its 200-day moving average by April. So above the 200-day moving average, above the 200-day trend line, good, right? Below it, not good. Here is just a couple more examples. This is 2010, much less severe, obviously, right? Market's heading up, coming off the 2009 bottom, and then it breaks down, and things are kind of choppy. When we go through periods like this, we start to wonder, okay, are things going to get worse? Because we can't see the right side of the chart. That's trend prediction. We never want to try and predict trends. That is a fool's game. But we can look here and watch this pattern unfold. We can see if the market can find itself back above its 200-day moving average. But in this case, we only saw a few days here and a few days here where the market was above its 200-day. So that would have been a time to be a little bit more conservative. In fact, this is, for the nerds out there, this is a pretty obvious head and shoulders pattern here, inverse head and shoulders. You got a left shoulder here ahead, a right shoulder, and then a neckline would be drawn right here with a breakout right around here. That big, nice, big, empty, powerful candlestick. So anyway, enough of the nerds. This is going to be 2011, the U.S. Treasury downgrade. We've got the market going up into 2011. Summer's going okay. We've got a peak over here in May of 2011. The market starts to go down. It tries to rebound. We get a lower high, higher low technically, but another lower high. In other words, things are consolidating, and then the market just breaks through the floor. U.S. Treasuries get downgraded here in the U.S., and we are very obviously below the 200-day moving average. Now the 200-day moving average is sloping down. We're below it. We're underwater. Probably want to be more defensive. Now, as things started to get better here, so higher low, higher high. Higher low, lower high, below the 200-day moving average. But breakout here, we're above the 200-day. And then if you drew a line, just a line going sideways right here, you would see that this is another higher high relative to the November highs, and that would be a pretty good conservative safe place to regain entry to the market. Now granted, if you look to the right, you would have gone up and you would have pulled back almost to the same point you got back in, but then we're back off to the races again. So that's 2011. This is 2015-16. I mentioned it in the intro. We've got the market peaking again, ironically enough, in May. The market goes down about 12%. Bounces twice. That's a double bottom. In hindsight, of course, things are a lot easier, right? We get back above water, below it, above it, below it, above it, back below it. Down market's down about 14.6%, I believe. Another double bottom here. There's no, for the nerds out there, there is a positive divergence in momentum going back to, if you look at momentum indicators like RSI, RSI 14. But here you can see the market got back above its 200-day moving average, which tells us, okay, maybe things are getting better. And then here's the 2016 election, where the market went down big 2 days in a row and then came right back. So it barely spent any time, literally was underwater overnight. That's it. And then it was right back again. So Here is, aside from the market being above its 200-day moving average. In fact, let me show you one more time because I just showed you a lot of charts. This is the current market. Again, current market above its 200-day moving average. You see a high here, a higher low, a higher high, a higher low, and the market is trying to print a higher high in this moment. Not literally today. Today the market's down. It's pulling back a little bit. No big deal. But aside from it being above its 200-day moving average, another thing that's happened, this is a slower chart. This is a weekly chart, which means every candlestick on here represents 1 week. So 5 days are baked into each one of these candles. And the red line is the 34-week moving average. The blue line is the 13-week moving average. So the blue line's faster because it's shorter. So you have 13 weeks. We've smoothed out the 13-week moving average. Whenever the 13-week moving average is below the 34-week moving average, that's kind of a risk-off indicator, or a risk-off study, if you will. And it says that, look, the trend is down on a long-term basis or intermediate-term basis. Here you can see it gets above it for 1 week, back below it, back above it, back below it, and then here we are. We've got a positive crossover as of this past week. And we're just going to kind of have to see what happens here. But a couple things I'm noticing. Not only do we see a positive crossover where the 13-week shorter moving average is crossed above the slower 34-week moving average, but I'm also seeing the slopes of these moving averages coming back up again. You can see here how the 34-week tried to move up and failed, headed back down again, tried and failed. So now we're trying again here, but you can see how this bottoming process is trying to form here. The market is trying to bottom. Whether it will or not, whether the market heads down first before it goes up again, I guess one of the questions I've been asked is, could we see these October lows breached? Is it possible the market goes down to those October lows or maybe even lower? Absolutely. Anything is possible. We live in a world of probabilities, not certainties. So what we're trying to do here is we're trying to stack the deck in our favor, and we're trying to make sure we're lining up the probabilities in a way that if things are healthy, if the weight of the evidence is good, then we want to be invested in a certain way. And then when I say certain way, we want to drill down if the market's in a positive trend or any market's in a positive trend, we want to then drill down into each of those markets and determine which are the best markets to be invested in. What I mean by that is it U.S. stocks? Is it international stocks? Is it commodities like gold? Is it which sectors are the best, the strongest relative sectors to be invested in? What about bonds? Are they safe enough to be invested in? Which sounds crazy these days to say, are bonds safe enough? But they haven't been for the last 2 years. Call it at least a year and a half. So anyway, I digress. Let's move forward here. So I mentioned the 13 over 34-week moving average. Here's a really nerdy, I don't want to say nerdy. This is not nerdy. It's actually really, really simple. It's just ugly looking, I guess, because it's X's and O's. This is what's called a point and figure chart. This is a very unique way of looking at the market because it takes time out of the equation. A point and figure chart only looks at price, and this is what's called a 3-box reversal method. So you need the price to go up at least 3 boxes according to the price on the right here in order for there to be a change in column. And then, of course, with each box, the price over here at the right needs to change. But this is a relative comparison chart. So what I'm comparing here is the S&P 500 versus its inverse. This is probably the nerdiest thing I'm going to talk about today. So what I mean by that is if we compared apples to oranges on purpose, we're saying which one is stronger, the S&P 500 owning the stock market, owning the S&P 500, or being short the market. Okay, so that's the comparison I'm looking at here. Which is better? Which is stronger? If the S&P is stronger, you're going to see X's. You're going to see an uptrend. You're going to see buy signals. And if it's in a downtrend, in other words, if it's not performing as well as its inverse, in other words, if it would make more sense to, if you were really aggressive, short the market, then what you would see is lots of O's, sell signals, and so on. So what I want to pay attention here to is in 2017, so these are the years at the bottom. 2017, here's a buy signal, a sell signal. This is fourth quarter 2018, really rough, right? Then we have a buy signal here. This is March of 2019, and the market's doing well. Buy signal, lots of X's, higher highs, higher lows. Pretty simple to look at here. Then we have in 2020, this is COVID. And this is March. This is number 3. We get a bump in March. Things are doing okay. And then all of a sudden the bottom falls out. We get a sell signal right there. Market goes down. Things try to bounce. Market goes down, sell signal. Market goes down, sell signal again. And then that same month, we haven't even hit April yet, and they've got a buy signal. Do you want to trust that buy signal? pausing on purpose here because it's really hard to trust the first buy signal because the market could be doing so poorly. So if you don't want to trust the first buy signal, you can always trust the second one. And I hesitate to say always because I could get myself into a lot of trouble there, I guess. So let me back up and say you shouldn't always trust anything. I don't want to end up having somebody on Twitter telling me that I said always, so therefore, I owe them money or something. But anyway, I digress. So the second buy signal right here would be one that would, obviously you would have missed out on some gains. That's fine, right? We can't be perfect. But here's a third buy signal. So now the market's doing really well relative to its inverse. But we get a sell signal here, a sell signal here. This is 2022, 21. So market's going down since 2021. And then we get a buy signal and another sell signal. So that August bounce last summer that failed, we can see it on a point and figure chart as well. And then we get a sell signal. Then we get a buy signal and a second buy signal. And the reason I'm pointing this out, so here's our first buy signal back in 2020. Here's a second one at the end of 2020 when we thought things are looking pretty good. 2021. Not a bad year initially, anyhow. If you look at the tail end of 2020 and the first part of 2021, but then here's a buy signal in 2022. Here's another one, 2023, February. And the reason I point that out is because if I go back to 2000 to 2014, this right here is the 2003 market bottoms. This is the dot-com bubble. This right here is the 2009 bottom, the mortgage crisis. And what I want to point out here is off the market bottom, off the 2003 market bottom, this comparison between the S&P and its inverse, second buy signal. Again, you missed out on a lot of gains, obviously, but this is, and by the way, this is just one indicator. This is just one study. Nobody should make their investment decisions based on one study, but I think that it's important to look at the weight of the evidence. That's what we do here, and we have multiple strategies. We don't just want to use one strategy. That doesn't make any sense. At least it doesn't make sense to us. So we have our second buy signal here, and then things look pretty good, but then the market falls out again. So we got here, this is, what would that be, October of 2005, 6, 7, market peaks, and then we head down again. Here's the first buy signal, second buy signal, and we're off to the races. This is a sell signal, 1, 2, second buy signal, off to the races. 2011 U.S. Treasury downgrade sell signal, second buy signal, we're off to the races. So this is I'm showing you this because I think it's interesting that we're seeing that second buy signal right now, and that in the past the market has tended to go up from here and not down after a second buy signal. So hopefully that makes sense. In the short term, if I drill down back to a normal chart here, where we're sitting right here is this area of potential support below our feet, call it like a floor. Here's all these little touches here. This is February. There's March, a little kind of where in March at the beginning of the month, the market tried to hit this point and then fell back again. And now we're sitting here where the market actually today, right now, the market is pulling back to this line. And in a perfect world, it would be nice to see it. It'd be nice to see it kind of consolidate here and then head northward. That'd be what I want to see. We don't want to see it go down. We don't want to see it break this line. But if it does, not all is lost because down here, this is not that far away. In other words, let me scan out because I think short term can kind of get really confusing. So right here is that line that we just looked at on the very, very bottom of the chart. So right now we're kind of consolidating sideways. This is my inverse traffic light chart. Right now we're, again, consolidating sideways, somewhat trendless. But again, I see a high here. I see a higher low, a higher high, a higher low. And now we're just trying to find out what's going to happen next. Are we going to breach these lows and then head lower? We'll find out. Are we going to breach these highs and head higher up into this green zone here represented by the summer highs and the spring lows of 2022? We don't know, but we'll find out. And again, right now, the way we're allocated, I'll share that a little bit later, but the way we're allocated is pretty bullish, I guess. I'm feeling pretty good about this market based on the evidence that I'm seeing across the board. So let me share some of that evidence with you. You know what? Before I do that, let's talk about just two stocks. I thought this would be fun. First one, I think you'll recognize the name, is SVB Financial Group. So SVB, this is, as you can see here, there's really not much to look at anymore. The chart won't even load. But the 200-day moving average. Remember, we were talking about that a second ago. This is another reason why it's so important. Again, nobody should use one study, one overlay, one indicator to manage their money. But if you look at this 200-day moving average and you look at SVB going underwater, you can see it would have been pretty helpful in determining whether or not you should stay in this investment or not. And I can say the same for this next one here, Signature Bank, right? Signature Bank, same story. Heading up between 2021 2022, and here in April of this past year, it was below its 200-day moving average, underwater, lower highs, lower lows. Would you have really wanted to own this thing anyway, if you were paying attention and if you believe at all in following the trend, or the trend is your friend until the end when it's not, right? And then here's something else interesting I wanted to share. So for those of you who are worried about the banking sector or the financial sector, this is the highs of the financial sector. This is the Spider Financial Select Sector Fund here, the XLF. These are two almost equal highs back in 2007. And you can see here, we tried, the financial sector tried to breach those highs in 2018, tried again in 2020 before failing as a result of COVID, and then broke north of those all-time highs. And since then, what was previous potential resistance above our head, ceiling of resistance, now becomes potential support. So here we have 1, 2, 3 times now it's tried to hit this line in the sand. The question is, are we going to break below that, or are we going to head higher? So far, regardless of these bank failures, so far things are going well and it's holding this line. And that's something that I'm going to be paying attention to here when looking at the overall market, because it's really hard for the market to go up when the financial sector isn't doing well. If our financial system isn't healthy, kind of hard to have a bull market. So, but anyway, so far, all this is just a pullback, a correction, so to speak, in the financial sector, and I don't think it's anything to freak out about just yet. Let's talk about bonds. So we look at the bond market. This is the aggregate U.S. Aggregate Bond Index, the AGG. Again, I mentioned earlier, the bond market has not been good. This is midway through 2020, and since then, the bond market's down pretty big. You can see here, if you draw a line and you with your eyes over here, it's about $119 a share, currently trading about $99 a share, bottomed out around 93. So this thing, I know last year the bond market was down over 14%. Which is not something that people are used to seeing in bonds. They're not used to seeing losses, let alone big losses. So right now what we're seeing is this choppiness. Remember I talked about the choppiness. The interest rates go up, bonds go down. Interest rates go down, bonds go up. So we have this, as interest rates chop up and down, we have bonds chopping up and down right now as well. And if you can't notice here, I know it's a little bit small. It's above its 200-day moving average for the second significant period of time this year. The question we have to ask ourselves right now are two things, in my opinion. One, can it stay above its 200-day moving average as the 200-day starts to curl around? That's the first question. And the second question is, can we break north of this kind of consolidation pattern and start to see some higher highs and higher lows? Because right here we have a high, we have a higher low, we have a higher high, but then we have a lower low and then a lower high. So right now this thing's in danger of breaking back down again. And in fact, you never want to complete patterns that don't yet exist. But this could be a left shoulder. This could be a head. This could be a right shoulder forming right here with a neckline descending along this line here. And if we were to break south of right around 96, call it 95.50, that would probably be a pretty severe breakdown, and we'd probably be looking at testing the $93 lows, call it 93.5 on the AGG. So interest rates, let's look at the opposite side of the coin here. This is the 10-year Treasury yield, which many people use as a proxy for mortgage rates. So the 10-year note here peaking out back in the early 80s and just going down, 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 down. And all of a sudden we get this bottom here in 2020 of COVID. And then since then, it's just been this huge spike. It's almost like a rubber band that's been stretched. And when you stretch that rubber band too far and too long, eventually it's got to snap back. But we're above that descending trend line going back all the way to 1980. And right now, I wouldn't be surprised to kind of see it bounce back and forth, especially when the Fed makes an announcement and says that they're done raising rates, which I think should probably happen here in the next couple months or so. They should be finishing up their tightening cycle, and rates should start to plateau and chop around and kind of head sideways until the Fed decides to lower rates, should they decide to do that at some point in the future. But what's interesting right now here is the distance between 3.43 and 2.6%. So this descending trend line would, if we kept extending it, would hit about 2.6%. If it were to go down from where it's at right now at 343 to 2.6, that's a drop of 24%, roughly. So just because it doesn't look like much here on this chart, we need to keep in mind this is a really, really, really long chart, going all the way back to the 80s, multi-decade chart. So little movements mean a lot here. Just keep that in mind. And then last but not least with bonds, I just wanted to mention 20-year treasuries, which really have been almost the worst investment to own. I think last year U.S. treasuries were down somewhere in the ballpark of 38%, I think it was. These are U.S. treasury bonds, government bonds. They were down 38%. So what we're seeing here is this low. We've got a high, a higher low, and now we really don't have anything but we could call this a rectangle pattern. So it's just kind of chopping sideways. It's trying to decide what direction it's going to go from here. I call this a pressure cooker. The longer this bounces back and forth in this little lane here between these guardrails, the more pressure builds up. And if it breaks out, it's going to break out big. And if it breaks down, I should say, it'll probably break down big because, again, this pressure builds up between buyers and sellers. Because the psychology of what's going on here is sellers come in and they start selling and pushing prices down. Then buyers come in and say, well, I want that price. And they start buying and pushing prices back up until sellers come in again, pushes prices back down. And so you get this back and forth, back and forth. And above this line up here are all these people that say, if it gets above that line, I'm buying. And as a result, that more buying obviously sends prices higher. But if it falls below this line, of course, then there's all these sellers below that line going, if it falls below this line in the sand, I don't want to own anymore. I'm hitting the sell button and I'm getting out, which would obviously cause a lot of selling pressure and hence a big breakdown in price. So this is why, as this pressure cooker continues, you get more and more investors that are playing in the game, and there's more people involved. And of course, then we have the fact that interest rates from the Fed are a part of this equation as well to a certain extent. So right now, we've been sitting tight since, November of 2019. We really haven't been invested in bonds almost at all. We've just been sitting in all of our portfolio models. We've been invested in short-term treasuries, short-term money markets, earning anywhere between 1% back in 2019 to these days paying anywhere between 3 and 4.5% per year. All right, let's talk about a little bit, just a couple slides about gold and the U.S. dollar, because I think this is really interesting and it's important. If you remember this from our market outlook update that I sent out in January, this is the cover of Bloomberg Business Week. The U.S. dollar, it can't stop, won't stop. Magazine covers tend to be contrarian indicators, meaning whenever you see a magazine cover saying one thing, usually the opposite tends to happen in the not too distant future. In this case, the magazines are saying there's, the dollar's going up and nothing can stop it. The dollar's just going to the moon. So this was an old chart. You can see here, October of 2022, last year, when I printed this chart out. Now look at it. Here's where that magazine came out. So the dollar's gone down. If we're looking at the DXY here, the dollar's gone down from as high as intra-week. This is a weekly chart, I think. Yeah, I don't have my notes. Anyway, I believe it's a weekly chart. But anyway, down from as high as 115 to sitting here where it sits now, right around in the low 100s. So down, call it 15% or so. And something to keep in mind when it comes to the U.S. dollars, when the dollar goes down, international stocks tend to outperform because let's just say you have a stock worth $100 per share here, and you have a stock worth $100 per share overseas, and the U.S. dollar goes down 5% relative to that country's currency. If the U.S. dollar goes down and you own an international stock that as a result has gone up in that currency, then we essentially make about 5% just on a currency exchange rate alone. So that's why you see this pendulum swing over time where international stocks outperform for a time and then eventually U.S. stocks outperform for a time. I guess fortunately for us in the U.S., since 2009, the U.S. has been the best performer. There's really been no place to go to outperform, which is also a reason why it's been extremely difficult to quote unquote beat the market this last, call it 13, 14 years. But what we're starting to see now as a result of the dollar pulling back and potentially breaking down and seeing a lower dollar is A, we're starting to see international stocks outperform U.S. stocks, and B, and by the way, for the first time in 15 plus years, by the way. And then B, we're also starting to see gold benefit because when the US dollar goes down, gold tends to do well. Another catalyst for gold is when interest rates go down, gold tends to do well because gold is, when the stock market goes down, gold also tends to do well because it's a safe haven asset. But let's look at gold for a second. This is a really interesting gold chart. So this is what we would call a cup with handle pattern. This is actually a high consolidation pattern. Normally a handle would kind of come down almost like holding a cup like this, downward, like a downward angle. But this cup with handle pattern here is sideways, which is actually more bullish than it would be if it were heading down. So this is basically saying that, there's a lot of buyers supporting these lower prices when, not if, but when the market's gone down here, the gold market that is. And then what we have here is one touch at all-time highs back in 2011. And then gold's just kind of gone down into 2016, went sideways, headed back up, broke north of those all-time highs here in 2020, but then pulled back, broke north again in 2022, pulled back, and for a third time, it's trying to retest and break north of those 2011 highs. And if it does, it's kind of like that pressure cooker thing again, where you've got all these investors up top here that are saying, first of all, if it gets above here and breaks out, I want to own it because there's nothing but blue sky ahead. There's no sellers up here. Second of all, if there's people shorting gold, people that are short the investment that benefit if it goes down, if it goes up too high, then the shorts are going to cover. In other words, the people who are profiting if it goes down, if it goes up, they have unlimited losses. So they're going to cover their short position if it goes up too high. And that's going to, in order to cover your short position, you have to buy. And that adds more buying pressure to gold, which can again cause things to go bonkers, I guess, for lack of a better word. And as of today, this is what I don't even know what the date is. It's I think it's the 4th. Yeah, you can see I was up late last night, 1:46 a.m. So I published this chart last night at 1:46 a.m. But today it's Tuesday, I think. Yeah, Tuesday, I think, the 4th. And it is 2:14 p.m. And last I looked at this chart, it was within less than 1% from its all-time highs, or from this, from its all-time highs. So anyway, I digress. I'm talking too much here. So let's keep moving. Market seasonality. This is kind of think big picture here. Think indicators, more evidence. We want to think big picture. This is the Smart and Dumb Money Index. This is Sentiment Trader. Sentiment Trader keeps track using COT data of essentially what are called speculators. These are people who maybe aren't the most professional traders in the world. They tend to be wrong. In other words, when they bet one direction, the market tends to go the opposite direction. So the smart money, this is March 24th. I pulled this because it's important why. There's a reason I picked that date. You see the smart money is way up here. And then you see the dumb money's down here. So this is confidence levels. And you can see the smart money is at 74%, dumb money at 41%. And then we want to look at a spread. So again, when the market tends to do well when the smart money is confident and when the dumb money is lacking confidence. The market tends to do poorly when the smart money is not so confident and the dumb money is really confident. You can see here, confidence in dumb money it correlates pretty closely with market peaks. But what I want to show you here is, again, this is from Sentiment Trader, is whenever the spread, so the spread between smart and dumb money exceeds 0.25. So we're comparing the last one was 0.27 on the 24th of March, but whenever it exceeds 0.25 and goes higher, the annualized return for the S&P 500 is 17%, and it only spends 17% of the time above that 0.25. Look at this. Between negative 0.5 and a quarter point, so from negative 0.5 to 0.25, the annualized return is 5.2%, and it spends most of the time there. And when it gets below 0.5, in other words, when dumb money confidence gets way above smart money confidence and it gets below that number, it only spends about 10% of the time there, and the return's actually a little bit higher. So these bottom two numbers don't really mean much to us, but the top number does. In other words, when smart money is above dumb money and the spread gets high, above 0.25 to be exact, it doesn't happen a lot, but the annualized rate of return is really positive. Another contrarian indicator I wanted to share with you here. This is All-Star Charts. This is, oh man, I forget who posted this. I apologize. I'll just say it's from All-Star Charts, my friends over there, JC and team. So thank you for posting this cool chart. But what we're looking at here is the difference between bulls and bears. So when I say bulls and bears, bulls are obviously people who feel good about the market. Bears, people who feel bad. Why do they call them bulls and bears? Well, because bulls attack with their horns from the bottom up. Bears attack with their claws from the top down. That's why they call bear markets bad markets and bull markets good markets. So with that behind us, you can turn off the video and you can go about your day, right? You've learned everything you need to know. No, in all seriousness, what we're looking at here is the consecutive weeks where bears have outpaced bulls. In other words, when they do sentiment indicators, or I'm sorry, sentiment surveys, this is the AAII sentiment survey, which I get every week myself to respond if I want to. It shows us, how many consecutive weeks have the number of bearish people or bearish investors outpaced the bullish investors. And you can see here, it's 44 weeks now, which is even worse than it was during COVID. So things, and that's a good thing. The longer this lasts, the closer we are to it being over with, if that makes any sense. Excuse me. Another statistic here from Sentiment Trader. This is again, remember I said small speculators, so small options traders, people who maybe aren't so what's the word to be polite? Maybe they're more gamblers than they are professional traders. Let's put it that way. They tend to be wrong a lot of the time. Right now, small traders really are not betting on the market going up. In fact, they're betting on the opposite. You can see here their position here down negative 40 right now. So they're not they're not very positive right now. And again, this is a contrarian indicator, which would indicate that the opposite. That if they're really negative, the market is probably headed northward. At least most, again, not certainties. Remember, we deal in a world of probabilities, not certainties, but the probabilities are such that when things are this bad in the speculators market, in the options market, then we tend to see things get better in the stock market. And here's some more information to support that theory. You can see here, again, kind of a similar statistic to what we looked at a second ago with smart money and dumb money, when the small traders, when the futures and options sentiment, their 3-year range is down below 5%, the annualized return, this is ridiculous, 60.4%. Now, in no way do I want any of you watching this video to even remotely think that you're going to get 60% per year going forward for any period of time. But I think it goes without saying that that's a pretty powerful indicator, pretty powerful study. And because when it's above 80%, like it was, you can see back here, 0.1% per year is all we're looking at. Now, 4% of the time, it spends above 80%. 4% of the time, it also spends below 4%. But in the middle, 92% of the time, it's 4.5%. But look at how big that opportunity is, I guess is what I'm saying. And you can see all the times when it's gone below 4% and where the market was up here at that time, which usually happened at or near lows or on rebounds, right? So, kind of interesting. This is from my good friend Ryan Dietrich. He's always got lots of good tables, and I just wanted to share this with you as well. This is when stocks stay above the December low. So when the market went up since October, pretty much, it's kind of been choppy. But when the market bottomed in December and then it headed higher, what we're looking at here is when the quarter one low is greater than the December low. Okay, and the quarter just closed on Friday this past week. Again, today I'm recording this on April 4th. So you can see here the final 3 quarters of the year end up about 11.1% on average. 9.3% is the median, and they're up 91.7% of the time. In other words, the win rate, up versus down, 91.7, that's huge. So let me say that one more time. Whenever the market at the end of the first quarter of the year following year, when the market bottoms in December, or there is a bottom in December, when it holds that December low, by the end of the first quarter, the average return is 11.1% for the final 3 quarters of the year. So again, more positive evidence here, which is what we're looking for. We want to see positive evidence. This is this is seasonality statistics from our Jeff Hirsch, my good friend Jeff Hirsch at Stock Traders Almanac. This is the stock market here. It's a little bit old, but this is the stock market this year so far. So we had a bounce, then things pulled back again, up about 1% or so this year or so at the time of this chart. But you can see in all pre-election years, because that's what we're in right now. Next year is election year. This is a pre-election year. It's the best year of the 4-year election cycle for stocks. But the average for pre-election year is up right in the ballpark of 16-17%. When you look at a first-term president, so it's obviously this is Biden's first term. When you look at every time there's been a first-term president in a pre-election year, you can see what the performance was, which is even better. Pre-election year, this one here is a pre-election year after the last year, and the midterm election year was a down market, a bear market, which last year was. So last year was a midterm election year. It was a bear market. Obviously, the market crashed, went down. And then here we have also really good looking numbers here on average. And then this is the aggregate, when we look at the aggregate cycles of all 4 years. So we're looking at pre-election year, post-election year, midterm election year. Average is just above, drawing my eyes here, 12% or so. So this is good. This is again seasonality, saying that things should be good this year, especially after we had a bad year last year. Now, again, I'm gonna disclose by saying, could things go down first before they get better? Yes. Could we see, even though the first quarter finished above the December low, could we see the December lows again? Yes, of course we could. Does that mean that the market's going to crash and head down another 20, 30, 40, 50%? No. Could it? Yes. What are the probabilities of that happening? Probably pretty small, especially since, again, when you look inside the market, stocks started going down in February of 2021, and now here we are sitting in April of 2023. So I think the longer it takes, the closer we are to the end of the bear market and a new bull market than we are to the beginning of it, if that makes sense. We have here March and April tend to be good months. So when you look at the average monthly returns going back to 1950, especially in pre-election years, right here, April actually is the second best month next to January. And you can see the other good months are June, July is pretty good, and then December is really good, obviously, December being the third best month of the year. So April this month should, based on the seasonality anyway, based on history, April tends to be a pretty good month for the market. So that's what we should see. If we see something different, then that's something we probably want to pay attention to. So, all right, so let's change gears and just kind of talk about the weight of the evidence here and what our portfolios look like right now at our office. In our strategic static models, these are models that implement asset class rotation, sector rotation, industry group rotation. Said another way, basically we're investing in the playoff teams and we're avoiding the rest, if that makes sense. So we are diversifying, but we're diversifying, but at the same time concentrating our money in the relatively strongest sectors, stocks, and so on. So in those models, what we're currently invested to target, like they always are. Again, they're static models. They're I don't want to call them buy and hold models because we're obviously making changes when needed, and again, staying invested with those playoff teams, but they're full invested to target, which means that if it's an aggressive portfolio, it's typically going to be 100% stock, whether that's here, U.S., overseas, in one way, shape, or form. A moderate growth would be like 80-20 and so on. So the focus right now are on industrials. So we're looking at sectors here, industry groups. We're focused on industrials, materials, food and beverage, discretionaries, semiconductors, that is, and gold. And then when we look at our trend following models, so our tactical defense first trend following models, these are the ones that also implement that asset class sector industry group rotation, stay invested in the playoff teams, avoid the rest, but they also have a second, call it more conservative filter, where they'll get out of the market and go to cash or money market if things start to look pretty cloudy and lightning's hitting the ground and tornadoes are going out. We need to hit a bunker. So this is our bunker portfolios, I guess. Currently, we've only got 15% cash or so, in money market equivalents in our balanced and conservative tactical models. That's it. So not a whole lot of cash right now, which, when I talk about the tactical models, I say the market is telling us what to do. And when the market is bullish, when we see a lot of uptrends, the portfolio models are going to be invested, even in a trend following model. Granted, keep in mind, this is trend following, not trend prediction. We have no idea what the market's going to do next week, next month, next quarter. So we're following the trends. We're not predicting them. But right now, the trend looks pretty good when you consider the fact that our moderate growth and aggressive models are fully invested at target. What are they invested in? Well, again, staples, materials, industrials, technology, and gold. Is where we're at. Our ESG model, it's environmental social governance, socially, easy for me to say, socially responsible model. Again, fully invested at target. It is, by the way, a strategic static model, currently focused on energy, medical, tech, staples, semiconductors, and gold again. So we've got gold across the whole gamut of all the models, in case you can't tell. And then when it comes to bonds, this is important. And I think this is probably the 6th or 7th time we've talked about it here on these quarterly screencasts, and that is we still don't own any bonds. I showed you the bond charts earlier, and there's just not a whole lot of exciting stuff going on in the bond market. And by the way, not to say investing should be exciting. It shouldn't. If investing is exciting to you, you're probably not doing it right. Investing should be stable, stress-free, calm. Exciting is more like gambling. We don't want to do that, obviously. But right now, we're still invested primarily, if not completely, I should say, in short-term treasury bills, kicking off, 3 to 4% per year is also nothing to go do cartwheels around the block about. But the bond market is still trying to find a bottom, in my opinion, and I don't know that maybe in the next week or two, maybe in the next month, I don't know when I'll be ready to start putting some chips on the table in our bond portfolios and actually investing in some other bonds. But for now, we're going to sit tight and wait for the storm clouds to dissipate, metaphorically speaking. All right, so that's it for this quarter's screencast. Hopefully you enjoyed it. Hopefully you learned something. If you have any questions, feel free to reach out to us. If you'd like a second opinion on your retirement plan, your portfolio, please know that we can set up an intro call and just chit-chat, get to know you better, understand your situation, find out whether or not we even want to go through our process. If you do want to go through our process after that intro call, if it makes sense, I should say, to do so, whether it be now or in the future, we have a discovery meeting, which is about 2.5 hours, say 2 hours, 15 minutes usually is where it sits. And second meeting is an education meeting, lasts about an hour, not usually more than that. And then our third meeting is a financial planning meeting where we go over cash flow analysis, both now and after retirement. If you're already retired, obviously we're focusing on retirement income. We go over big picture advice for things like retirement planning, investment management, tax planning, insurance planning, estate planning, and all the things that have to do with your financial house. So the goal is to get your financial house in order, and our goal is to act as your personal CFO, so to speak, treating your house like a business. So with that all being said, thank you so much for your time. I hope you enjoyed the presentation today. Again, anytime you have a question, you never have to be a client to ask a question. Feel free to reach out. Otherwise, enjoy the start of spring, and we'll talk to you soon.